Hello and welcome back to our weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Now, before we get started, if you can slap a like on this video, subscribe to our YouTube channel, helps us get out to new eyes and let them know what's going on in the market. Now, let's get to it. So this past week, we saw the market up 1.22%, which brings us year to date up 12.68%. Really, though, the biggest story this week has been the roller coaster ride of inflation expectations. Started up on the week pretty well, and then right around here is exactly when Janet Yellen came out and said, oh, well, we might have to raise interest rates a little bit sooner. I don't know if we are going to be able to keep the same pace as we were expecting. I'm a little bit nervous about the economy overheating. As soon as the market heard that, sharp sell-off, and then it was very interesting. She actually had to go back on later that day to correct herself and say, that's not entirely what I meant. I don't think that we're going to be raising interest rates. And she said, basically, she appreciated the autonomy within the Fed. She said, look, if there's any one person who appreciates the autonomy that the Fed has, it would be me. So she wasn't making a recommendation. It was just one of her observations. Either way, the market really hated that. All of a sudden, the market's starting to price in, wait a minute, inflation might be coming back in a very realistic way, faster than we're expecting. But the market did start to trend up, low volatility. And then what we see right at the end of the week, which is super fascinating, we had the jobs report come out. And just in many ways, one of the worst jobs reports we've seen, with the biggest miss in the past 4 decades. Economists were expecting 1 million jobs added and only 266,000 jobs were added. So almost a miss of like 800,000, 750,000. And yet the market loved it. Now, the first question is, why on earth could that be? But really what it gets down to is there was a massive fear that the economy was growing too quickly, too fast, and we were almost overheating. And what happens when we overheat is then we get to inflation, really, really fast inflation, potentially even hyperinflation. And what would that cause the Fed to do? Raise interest rates a lot faster. So we had one of the worst economic reports, but the stock market loved it. It's like, wait a minute, we're going to keep our money printer going. We're going to keep getting our stimulus, and we're going to grow, but at a steadier rate, which is actually exactly what most people want. It's what the Fed wants. It's what the market wants. Growth at a steady, consistent rate is the best thing for the stock market, the best thing really for the economy, except for the people who are currently unemployed.
And it also is something that's sustainable. So manufacturers and CEOs of companies can easily plan around steady growth. It's much harder to plan around hyperinflation. It's much harder to plan around crumbling economy, like what happened with the pandemic. Those big shocks and changes makes it more difficult for companies to plan. And as a result, they're not investing as much, and we see a decrease in general economic activity. So everybody sort of likes this.
We've already seen in many cases a shortage of supply. And what Rich is speaking to is when we see massive growth in the economy, massive spending increases, that already shortage in supply gets squeezed even more. A lower supply with higher demand, higher prices. So it just feeds that inflation beast. And once you're feeding that inflation beast, it grows larger, 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 faster, faster, until the Fed has to step in.
That is correct. It's basically what we saw back in the 1970s.
Now, speaking about the massive inflation fears, what we saw when the jobs report missed completely, we saw a drop in the Treasury, which makes sense. The 10-year Treasury tracks inflation expectations. So it dropped about 10% early in the day, but something that was very interesting throughout the day on Friday, it actually started to recover and wound up just as high as the day then it started. So what does that tell us? One thing that we're looking at is, are people seeing this as the trend? Are they expecting it to continue to grow at this rate? Or are people seeing this jobs report as almost a fluke? It's an estimate. We're going to see a month or two from now, they're going to be revised up. And that could potentially be where some people are indicating early on, at least. Because what we saw is tech rise dramatically at the beginning of the day and then start to sell off throughout the day, which means people digested this report and continued on with the trend. So we have those two pieces playing against one another. Not a ton of clarity right now. But Rich, what are your thoughts on, is this a one-off or is this the steady trend for the economy?
Well, we often see these type of changes. We often see one-offs that occur. I think one report does not a trend make. We'll have to see what the next report shows, and then I would move forward. You know, when we're doing investing for everyone, we always look at 1 year, 3 year, because we know that there are huge variations from report to report, and we don't want to get that confusing us as to what we really need to do.
Yeah, so as we spoke about a few weeks ago, the first hurdle that we wanted to get over was earnings season. And I think we got over that earnings season hurdle pretty well. And then the next hurdle that we had in front of the economy was inflation. And instead of full out clearing that hurdle today, I think it was a good first step. We're not out of the woods yet when it comes to inflation. If we see the next few jobs reports numbers come in where we're adding 1 million jobs a month, that might lead to overheating, and that's the last thing that we want. So we haven't cleared that yet, but if we do clear that, I think it's pretty smooth sailing, for the rest of the year as it comes to big catalyst movements.
Yes, that is true. I agree.
We'll head to you for your fun fact of the week. What are you looking at?
Well, basically, we see a great deal of going on in Europe right now. The EU zone has had what's considered a double dip recession. In other words, they had a recession, then there was some slight recovery, but now the economy is contracting again. And this shows the difference between EU thinking and what's been happening here in the United States. EU has always been much more concentrated in keeping debt down, not having very out of control spending. As a result, their economy did not recover very fast during the 2008 recession, and we're seeing once again that they're having some problems after the pandemic. I think that this is just an indication of the difference in mindset, and to me, the EU just hasn't learned their lesson from the 2008, that they need to be spending more and they need to be less focused on running deficits.
Yeah, especially when interest rates are so low that you can acquire more debt and really help your economy out. Now, I will say one thing about that. It's a little bit harder when you're an individual country in the EU and you don't control your own monetary policy, because it's the, combined group that controls it. So Germany can't just say, all right, we're going to increase and get this stimulus package for us. So it does make that a little bit more difficult when you're part of the EU versus the United States, but it's a good contrasting comparison to see how we are able to rise out of this past recession. And many people are saying that, yeah, we are in the next, growth bull market.
Absolutely. And it also shows about how quickly certain economic groups can move versus others. The EU has always been slower, and they've always been much more concentrated on deficit spending. And that's basically because Germany is the big powerhouse there, and they've had this issue since the 1920s when they had hyperinflation.
No, well, thank you for that. Interesting to think about. As always, we're here to support you. Your Mind's here to support you. We appreciate you guys taking the time to tune in with us, and we'll see you again next week.